The Starter Home Playbook. That's right. Today I had a discussion with a client about a video I posted yesterday that the average age of a first-time home buyer was 40 last year. That's up 7 years in just a short period of time. It used to be 33 like 4 years ago. And we were getting into a discussion about home affordability in single-family homes. And so I told him the only reason it is 40 is because people aren't educated that they could actually buy a home sooner. And he goes, okay, Kevin, my credit score is 720. Prove to me I can buy a single family home in Alexandria, Virginia. And so I said, let's go. Let's do this. So the objective of this exercise was finding the least expensive home that he would potentially move in. So I told him I'm going to find the three the least expensive single family homes in Alexandria. We're going to look at one of those and we're going to run numbers on that. I said, let's evaluate the pictures. Let's get the tax data. Let's figure out interest rates. Let's assess down payments. We're going to do 3%, FHA 3.5%, and conventional 5%. And then we're going to look at down payments, closing costs, how much is needed, and how much income he would actually have to qualify. So let's get into it. First and foremost, I have some advantages that a lot of other loan officers don't have. And that one of those is the fact that I am also a licensed realtor and a licensed insurance agent. So I have a few more capabilities than some loan officers. So we're going to punch in active 223 zip code. We're going to do detached. And that's all we're going to do. And we're going to find out what's available. And we're going to click here and we're going to sort by price. So the cheapest home in Alexandria right now is single family. Been on the market 13 days, 7 days and 1 day. So we're going to look at those. Let's check out the first one. And we went through this exercise with the client. I'm like, blue carpet, Kevin, that ain't happening. He said, I would not buy that house. Go to the next, right? So we went to the next one, 4817 Upland. We looked through, he goes, decent sized yard. He says, it's nice. Could use a little updating. He says the kitchen needs some work. Don't love the wallpaper at the top. He says, let's look at the next one. So we looked at the next one, 3203 Elmwood. Been on the market 1 day. Nice front yard, nice backyard, hardwood floors. Looks like granite countertops. Little bit updated kitchen, stainless steel. Bedroom near the back door. He says, I think that was probably not originally that way. Probably convert that back to a TV room. But he said, you know what? Let's go with that. Let's check this property out and do a profile check on this. So we got $524,900 is the purchase price. We have next piece of data we need to get is this 6498 is the taxes. That is $541.50 a month, and I'm going to use $145 for insurance on this house. No HOA, which is nice. So generally, what I would then recommend is go to a title company's website and go to their quoting engine and price out the actual price. You put in the address, put in your loan amount, and it will give you their actual price that Republic Title would use in this instance. I recommend everyone go there. They're one of the best priced in the Northern Virginia area. If your realtor wants you to use Title One, KVS, whomever, right? Shop, okay? Just because they write that name in on the contract and you're quasi mentioning that's who you're going to use, you're not obligated. You can switch that title company. But you don't have to. If you're smart, you can get the best of both worlds. If your realtor's comfortable with XYZ and they have contacts there, ask them to match another title company's fees if you found one that's a little bit cheaper. They're probably going to do that because they want to keep your business, and you get the best of both worlds. You get to use who the agent wanted you to use, and you're taking my recommendation and saving a little bit of money. It can be anywhere from $500 to $800. Save the money. Next thing to do is we need to price out this loan, right? So in this particular instance, here's I already have this pulled up. Purchase price $524,900, 5% down. We're going to submit that, and we're going to get a price 5.875 on the 5%. Let's push that over to the 97%. Check that out. Normally they're the same, just FYI. The difference with certain lenders can be the amount of the mortgage insurance that you pay on a monthly basis. So some of my lenders are the same in both of these categories because we're going to be trying to do it under a home ready or home possible scenario. So 5.875 is on the 3% down. Now let's check out that FHA price because that is going to be different. $5.375 on FHA. Now you're saying, oh wow, that's a lot lower than the 5.875. Don't forget on an FHA you have 1 3/4 upfront mortgage insurance premium, so it gets added on top of that loan. So to break that down quickly, on a $100,000 deal, if you're putting 3.5% down and then adding 1 3/4 back, you actually put 3.5% down, which would be 96.5 on 100,000. But then you put back 1750 on that, so you're really financing 98,250. So get a lower rate, but you actually go a little bit backwards on the earlier part of the loan. It's for default purposes and to run the program. It also has mortgage insurance that never drops unless you put 10% down. So there are some differences. Just because it's a lower rate doesn't mean it's the better product. So we now have interest rates, we have closing costs, and now we can get into some of these numbers. So in general, I'm going to pull up a comparison sheet that I have already done, and we're going to go through some numbers here, okay? So on the 97%, 5.875, we have a down payment of $15,747. Closing costs are $10,556. Escrow startup is $42.38, and so we have cash to close of $30,541. I'm going to get into breaking down some of these closing costs later. So if you can stay with me through this exercise, I will give you a more in-depth basis on what closing costs are. Okay. So in both of these situations, on the conventional 5% down, you have a little bit more down payment, $26,245. You have closing costs are about the same across the board between all three of these deals, and then the escrows are just slightly different based upon mortgage insurance requirements. So with the 5% down, you have $40,000 that you need. FHA is 32, and then the 3% down is 30,000. Now, payment-wise, when you look at all of these, the 5% down does have the lower payment. It has the lower MI, and in general is my preferred option if you can come up with this money. Now, one thing to keep in mind, this closing cost number and these prepaids, you can ask the seller to cover those costs. So you can get into a home essentially with just this down payment money, $15,747, $18,371, and $26,245. So with these payments being at these levels, if you had no debt, you would be able to buy these homes. I'm going to give you these numbers. You would be allowed to buy these with a 49 back ratio. So you could get into this home with as little as, and I'm going to go with the highest one, 78.59 a month income times 12. So $94,308 to buy this single family home. You would need an income of that amount of money. Okay. So with a 720 credit score, that's what you would need. Okay. Now, if you want to look at a breakdown and understand true closing cost, okay, this is going to be on the 5% down scenario. I'm going to give you an old school breakdown on closing cost. So this is the old good faith estimate that we used to use when I first started the business 30 years ago. You have closing cost on this side, a breakdown of escrows below that, a compilation of all the numbers, an accounting of all the numbers, and then the actual payment. So we're going to go into this. The admin fee or underwriting fee, most either have that or a processing fee and an admin fee. We kind of call them lender junk fees, unfortunately. You can get those waived, but then they just roll it into the interest rate and give you a higher rate. So in general, usually better off to pay the admin fee or underwriting fee. $11.95 in this case. Appraisal fee, self-explanatory, $540. In some cases, you might get an appraisal waiver if you're putting 10% down or greater. You might get out of paying that fee. Credit report fee, $150, self-explanatory. That could be as low as $94. Tax service and flood. Tax service monitors make sure that your taxes got paid. The flood monitors the life of the loan that the house is in a flood zone. Work number. If your employer subscribes to the work number and they do your verifications of employment through there, that could cost money. If that's not used, that comes off. Any of these fees that if they're not used or done, come off, and they always have to be actual fees. Settlement company fees, use Republic Title here, $4.95 on settlement. Lender's title insurance, that's what protects the lender that you're in a first lien position. If for some reason title company screwed up, this protects the lender, gives them insurance. Insured closing letter protects all the money in the transaction. Recordation of services. People don't take these things to the courthouse anymore. They just record them electronically. The recordation cost at the courthouse, the deed and the mortgage, $75 each, essentially in Virginia. And then you have city and state recordation, $3.34 per thousand. A third goes to the state, no, a third goes to the county, and 2/3 go to the state. Owner's title insurance, that is what protects your interest, and you should always get it, in my opinion, okay? It protects that you have clear title for you to buy the property. There's no other heirs, no other people that have a right to this property. If, in fact, you don't buy it, the lender's protected because they require it, but you would not be. So, in general, you should always get it. The next 4 items: pest, home, radon, survey, all optional items, not typically required to get a loan. The termite is if you're doing a VA loan, okay? Escrows. Think of an escrow account as a savings account. First and foremost, the interest to the end of the month. If you bought the property on the November 20th, you have 10 days to get to the end of the month. You owe, that's the only time you're ever going to prepay interest on a mortgage. Mortgage interest is always in arrears. So when you make December's payment, you're paying November's interest. So if you closed, hypothetically, November 20th, you would prepay 10 days to December 1st. live in the property all the way to January 1st and make your first payment in January. January covers all of December's interest, okay? So next is your hazard insurance policy or your homeowner's insurance, right? I quoted you $145 a month over here. You have to start up with 1 year policy. The policies are for 1 year. You pay for that policy at closing. It's good for a year. A year later, this escrow account pays this for you. Okay. You do start up the escrow account with 3 months. That's because you don't really make a payment. They're allowed a 2 month cushion. So 12 months from a year from now plus 2 months is 14. You'll make 11 payments before it's due again. So that's why you collect 3 at closing. Same for the 2 month cushion on taxes. In this situation, you'd pay 2 months to start up the escrow for your taxes. So all that adds up to be $4,200. Those numbers get pulled over here to box F. Okay, you have your purchase price $524,900. You have closing cost $14,639. Here's your total $539 minus your loan amount. This is the 5% scenario. 95% loan to value. You need your $40,000. Keep in mind here, the amazing thing is you can ask the seller to pay this $14,600 and some dollars. You do not have to pay that. You can negotiate that into the price, and quite often it's better for you in a lot of instances. Maybe with the market slowing down and inventories being up, maybe this $524,900, you might be able to ask for a $10,000 seller credit. You pay that difference. You do a hybrid, okay? So when everything is said and done, you can buy a single family home in Alexandria with under $100,000 if you had no debt, okay? Now, if you do have additional debt, it would increase the income that you would need to qualify, okay? The more money you have to put down, the better it would be. Also, the higher the credit score, the better the interest rate, lower the mortgage insurance, and it would also allow you to have or need less income to qualify to buy this single family house. So when I showed my client that this was possible, he actually made a lot more money than the 94,000 and change that was required to buy a single family home in Alexandria, Virginia. So I hope this was helpful. I'm going to start doing this on some other properties and educating people on closing costs. It's the big thing that's unknown in many cases, and a lot of realtors aren't breaking down those costs for you and or loan officers. So if you ever have any questions and or you get an estimate from another loan officer and you want some help understanding whether or not you're getting a good deal or not, even if you're not in Virginia, Maryland, or DC, I'd be happy to help. My name is Kevin Retcher, owner of First Meridian Mortgage. This was your starter home playbook. And yes, you can buy a single family home in Alexandria, Virginia with a 720 credit score with under $100,000 in income. My name is Kevin Retcher. Talk to you soon.